Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, February 2nd, 2024. The parade of good economic news continued this week. Today, we learned that the economy added 353,000 jobs in January. That is far more than the 185,000 figure anticipated by Wall Street analysts. Also, the number for December was revised upward by more than 100,000 jobs. The unemployment rate remained unchanged at 3.7%. Now, at the same time, wages rose 0.6% last month and increased 4.5% during the past year. Those numbers were also higher than expected. What is especially surprising about these very strong labor statistics is that they arrive at the same time that many large corporations have announced that they will be downsizing their workforces this year. But if these numbers accurately reflect demand for labor, then those people should not be out of work very long. At first glance, it would appear this is good news for the stock market. Since the start of this year, the SPDR S&P 500 ETF Trust, or SPY as it's commonly referred to, is up more than 3%. But that's only half the story. In fact, it's a lot less than half the story. Since the S&P 500 index is cap-weighted, only a small fraction of its components account for most of its upward movement. If we look at the S&P 500 index on an equal weight basis, a different story emerges. The Invesco S&P 500 Equal Weight ETF, or RSP, which as its name implies gives equal weight to every stock in the index, is actually down slightly this year. Until the start of this year, both ETFs had moved in the same direction at the same time, although not to the same degree. So here's the equal weight over the past 6 months. You see it bottoming out at the end of October, rallying through the end of last year. But here we are now at the start of this year where I have the cursor, and look, it's just flat. Now if we come back over here to the SPY, same pattern. Now we move over to the start of this year, and guess what? It keeps going up. And I'm going to include a graphic here in this video to show you, and you can see the circled area on the far right. That's when they stopped moving together. So that begs the question, why is Wall Street piling into mega cap stocks if the economy is growing? In theory, smaller companies should benefit just as much from a healthy economy. In a word, it boils down to trust. And right now, Wall Street doesn't trust the economic numbers to remain as strong as they have been recently. I don't know what empirical data they are looking at to feel that way. Yesterday, and here, let me take you over to this report, but yesterday we learned that the ISM Manufacturing PMI Index rose 2 percentage points in January, while the new orders index jumped by more than 5 percentage points. Those are big jumps. Usually it goes one way or the other, maybe 2-3/10%. But for the indexes to go up by 2% and 5 percentage points respectively, that's big. In short, the economy appears to be roaring back to life. Perhaps that is the problem. If the stock market's recent rally was predicated on the assumption that the Fed will start cutting interest rates soon, then the inflation figures for January that will be released later this month better show some improvement. At the moment, it does not appear that lower interest rates are necessary to stimulate the economy and may encourage more spending that increases demand and thereby raises prices for consumer goods. I believe it is that scenario that explains Wall Street's reluctance to embrace small and mid-cap stocks. That's this week's PF video update, and I look forward to talking to you in another week. Thank you.